Good morning, everyone. Let's begin with the monthly financial review. Could you walk us through the hotel's overall performance this month?
Overall, the hotel delivered solid top-line performance this month. Total revenue came in approximately 3% above budget, mainly driven by stronger occupancy and higher than expected F&B revenue. However, despite the positive revenue performance, GOP was below forecast by around 9%. The main pressure came from higher operating expenses, particularly payroll and utilities. From a profitability standpoint, the revenue flow-through was weaker than expected, so we'll need tighter cost control moving forward.
Occupancy was stronger than forecast, but ADR was slightly below budget. What's your assessment of the revenue variance?
The positive occupancy variance was mainly driven by corporate groups and several last-minute MICE bookings during the second half of the month. However, ADR came under pressure because we offered more promotional rates to maintain market share during low-demand weekdays. Overall, the higher occupancy helped offset the ADR decline, which resulted in RevPAR slightly exceeding budget.
Which departments performed above expectations this month?
F&B delivered particularly strong performance this month, exceeding budget by approximately 6%. Banquet events and weekend dining promotions performed very well. Rooms revenue also exceeded expectations due to stronger occupancy. On the other hand, spa revenue underperformed, mainly because international guest traffic remained softer than forecast.
Can you explain why operating expenses increased so significantly this month?
Certainly, the largest budget deviation came from payroll expenses, which were approximately 8% above budget. This was mainly due to overtime costs, additional casual labor for banquet events, and higher staffing requirements during peak occupancy periods. Utilities also increased substantially because of higher electricity consumption, particularly from air conditioning usage during extremely hot weather conditions. From a financial control perspective, we need stronger monitoring of labor productivity and energy consumption next month.
What corrective actions would you recommend for next month to improve GOP?
I would recommend focusing on three main areas. First, we should tighten payroll management by reducing overtime and improving staff scheduling efficiency. Second, department heads need to strengthen expense discipline, especially for utilities and operating supplies. Third, from a revenue perspective, we should focus on improving ADR quality rather than relying heavily on discounted business. If we can improve cost control while maintaining current occupancy levels, GOP performance should recover next month.
Are we overstaffed right now?
I would say certain departments may currently have opportunities for manpower optimization, but overall, staffing levels should be evaluated carefully based on operational demand and service expectations. In hospitality, staffing requirements fluctuate significantly depending on occupancy, banquet activity, seasonality, and guest mix. While payroll pressure remains a concern, reducing headcount too aggressively may negatively affect service consistency, employee morale, and operational responsiveness. The focus should therefore remain on productivity improvement, scheduling efficiency, and workforce flexibility rather than purely reducing staffing numbers.
Which expense category concerns you the most?
Currently, payroll and utility expenses are probably the most sensitive categories from a financial management perspective. Labor costs remain under pressure due to wage inflation, overtime exposure, and operational staffing requirements. At the same time, utility costs continue fluctuating because of energy pricing in occupancy-driven consumption patterns. Both categories are operationally critical, which means cost management must remain disciplined while still protecting guest experience and operational stability.
Do you believe the forecast was realistic?
Overall, yes. I believe the forecast was commercially realistic based on the market visibility and operational assumptions available at the time. However, hospitality forecasting always involves uncertainty because business conditions, booking pace, and operational costs can change quickly. Some variances occurred due to stronger than expected operational expenses and changing market dynamics. Going forward, more frequent forecast updates and stronger cross-department communication will help improve responsiveness and forecasting accuracy further.
Can finance support departments more proactively?
Absolutely. I believe finance should function not only as a control department, but also as a proactive business partner supporting operational decision-making. Earlier operational involvement, more regular communication, and stronger data visibility can help departments manage performance more effectively. Finance can provide support through forecasting insights, productivity analysis, cost visibility, and commercial evaluation to improve overall business alignment.
Should we revise staffing guidelines?
I believe staffing guidelines should be reviewed periodically to ensure alignment with changing operational realities and business demand patterns. Hospitality operations today require greater flexibility because occupancy, guest expectations, and business mix can fluctuate significantly. Revised guidelines may help improve productivity, scheduling efficiency, and workforce planning consistency. However, any adjustment should remain operationally practical and carefully balanced with service standards and employee sustainability.
Would you prioritize occupancy or ADR next month?
I would prioritize balanced revenue optimization rather than focusing exclusively on occupancy or ADR. If market demand remains relatively stable, protecting ADR and rate integrity should remain an important priority for long-term profitability and positioning. However, during softer demand periods, selective occupancy growth through targeted segmentation and tactical promotions may support overall revenue performance. The key is maintaining healthy business mix and maximizing total revenue contribution rather than chasing occupancy or volume alone.
How aggressive should pricing strategy be?
Pricing strategy should remain competitive and flexible, but still disciplined enough to protect long-term market positioning. Tactical promotions and dynamic pricing may be necessary during weaker demand periods, especially within highly competitive markets. However, excessive discounting can negatively affect ADR recovery, profitability, and guest perception over time. The objective should be balancing short-term occupancy support with long-term rate sustainability and revenue quality.